Hello, I'm Dan, a buy-to-let mortgage advisor here in the UK. Today, we're diving deep into the question that many landlords and property investors ask. Should you purchase your buy-to-let property through a limited company or in your personal name? This decision can have significant implications on your taxes, mortgage options, and overall investment strategy. So let's break it down. First, let's clarify what we mean by personal name and limited company ownership. Personal name ownership has until recent times been the most common way to go. You buy the property as an individual and any rental income you earn is added to your personal income and taxed accordingly. Limited company ownership has been around for quite a while, but it's becoming a lot more well known and common. You set up a company, commonly referred to in the industry as an SPV, which stands for a special purpose vehicle. This is a limited company that is solely created to handle property investments. The company owns the property and the rental income is taxed under corporation tax. You can purchase a property under an existing trading business, but not all lenders like this. Each structure has its own set of advantages and considerations, which I'll explain now. Taxation is the main reason most people consider setting up a limited company, but it isn't always the right fit for everyone. In your personal name, your rental income is taxed at your personal income rate, whether that's 20%, 40%, or 45%. Since April 2020, you can no longer deduct mortgage interest from your rental income. Instead, you receive a 20% tax credit on your mortgage interest payments. Within a limited company, rental profits are subject to corporation tax, currently at 19% for profits up to £50,000. Mortgage interest is fully deductible as a business expense, potentially reducing your taxable profit. It is important to note that while limited companies offer tax efficiencies, extracting profits via dividends can incur additional tax liabilities. Always consult with a qualified tax advisor to understand the full implications for your situation. If you don't know one, just contact me and I'll put you in touch. You need to be aware that the mortgage options differ between the two ownership structures. In your personal name, there are a wider range of mortgage products available, generally with lower interest rates, and the application process is a lot simpler. In a limited company, there are fewer lenders that are offering these products, although it is still a healthy amount to be fair, as more lenders have started to get into this market. Interest rates can be higher compared to owning it in your personal and a more complex underwriting process, but you can use a mortgage advisor such as myself to navigate this to make your life a lot easier. However, the tax benefits of a limited company can sometimes outweigh the higher mortgage costs, especially for higher rate taxpayers. It is definitely worth speaking to a tax advisor about this, as it could save you a small fortune. Let's consider a hypothetical scenario. So if you purchase a property for £250,000 with a rental income of £12,000 a year, and the mortgage interest is £6,000 a year, so half the rental income, in your personal name, the taxable income would be £12,000. If you're a higher rate taxpayer, you'll be taxed at 40% on the £12,000, which is £4,800. You only get tax credit on mortgage interest of 20%. So 20% of the £6,000 mortgage interest is £1,200, which means you have a £3,600 profit after tax, as you've deducted the £1,200 from the £4,800 tax due. This is where a limited company can benefit. You would have a taxable profit of £6,000 after deducting the £6,000 mortgage interest. With corporation tax at 19% on the £6,000 profit, this is £1,140, which leaves you with a net profit of £4,860. So in this example, the limited company structure results in a higher net profit. However, remember that extracting this profit, such as dividends, will incur additional taxes. But I would say that most of my landlords aren't taking out any profit. They're letting the profit accumulate in their bank account to build up another deposit to purchase an additional property. A handful plan to retire from work early, which means that they can quit their job where they're a higher rate taxpayer and then draw down the dividends as a basic rate taxpayer and live off of that. I've probably made it sound easy because to me, it's what I do every day. I would like to point out that operating for a limited company comes with added administrative duties, but you can get an accountant to handle these in fairness. You will need to file annual accounts and corporation tax returns and stay compliant with the Companies House requirements. Of course, you'll have potential costs for accountancy services to be aware of, But again, you're likely to be receiving more profit in a limited company and their costs are tax deductible. You could argue that owning a property in your personal name involves less work, but you do have to still file a self-assessment tax return, whereas in a limited company, you can employ an accountant to do the paperwork. Yes, you can employ an accountant to file your self-assessment, but that also eats into your profits even further. Consider the following when you're choosing your ownership structure. Your portfolio size plays a part. Larger portfolios may benefit from the tax efficiencies of a limited company. Higher rate taxpayers might find limited companies more advantageous. And if you plan to reinvest the profits, a limited company allows you to retain the earnings within the company, potentially deferring personal tax liabilities. I have seen people state that limited companies can offer more flexibility in estate planning, but mortgage lenders do not like you changing the ownership structure of the company, as you'll need to sign personal guarantees. So tread carefully if this is your intention. This is a complex area acquiring specialist advice. In summary, both ownership structures have their merits and drawbacks. The best choice depends on your individual circumstances, financial goals, and long-term plans. As a mortgage advisor, I can help you navigate the mortgage landscape for both options. However, for tax-related decisions, it's crucial that you consult a qualified tax professional. I create straight-talking videos for UK landlords covering buy-to-let, bridging loans, and smart property finance strategies. If you're serious about growing your portfolio, YouTube's picked a video for you. Give that one a watch next and drop a comment below if you have a question. Thanks for watching. I'll see you next week.